morning, everyone. Thank you for joining our webinar. My name is Lauren Enlow, and I am the Associate Director of Development here at Penn State Abington. And I'm happy to have Mike Degenhart, the Assistant Vice President of Planned Giving, and Judy Spiegel, the Director of Gift Planning from University Park. Thank you guys for coming down.
Thank you.
So today, we are going to talk a little bit about how you can leave your legacy at Penn State. We're going to have Judy and Mike go through their presentation for probably about 30 minutes. And then we are going to have the chat room open for anyone that has questions. If I could just do a sound check with everyone. Can you hear all of us? Just type in the chat room yes, if you can hear us. Excellent, thank you, Dane. So I'm going to turn things over to Judy and Mike, and please know that after today, we're going to send out this recording to everyone, so you will have access to it. And we're also going to send out the PowerPoint as well. All right, so let's go ahead and get started talking about leaving your legacy at Penn State.
Great. Thank you, Lauren. First of all, gift planning is the combination of a donor utilizing their financial planning goals, their estate planning goals, and their philanthropic goals to make a gift to Penn State Abington. There are many benefits to make a gift that are simple and low-cost strategies, which we'll be going through some examples later today on this presentation. We feel they're cutting-edge strategies, especially in light of the recent tax law update last year. We will also talk at the end of the presentation how you start your journey to pay it forward and leave a legacy to Penn State Abington. So let me start with what our definition of gift planning is. It's really the process of designing charitable gifts so that a donor can realize their philanthropic objectives while maximizing tax and other financial benefits.
So there are many ways to make a gift. First of all, you can give cash outright today or make a pledge, or you could give a gift later. And we often use bequest or beneficiary designations to do that. You can give an asset today and receive income, such as through the gift of a life income trust. And we sometimes refer to gift annuities or charitable remainder trusts as vehicles as a way to do that. And then another alternative is to give the asset, take the tax deduction, but decide the intent of the gift later. And for that, we use donor advised funds, or what are sometimes called DAFs. And Penn State has its own DAF called the Penn State Giving Fund. Gifts can be given through many assets. We start with cash, that's obvious, cash and credit cards, but there's many other ways to make a gift. And you can use securities, real estate, retirement plans, including your IRA and IRA QCDs. You can use life insurance policies, perhaps business interests, or if you have a collection or artwork. These are all assets that can be used to make a gift.
We're going to go through a few case studies. I like to sort of use the apple tree analogy, and as we go through the case studies, you will see why. If your gift is to make, if your goal is to make a gift where the funds are immediately available, give the apple tree now by making an outright gift. And that can be a one-time gift or a pledge. Again, these can be funded with cash, appreciated securities, closely held stock, real estate, personal property, and for donors who are age 70 and a half and older, they can give money from their IRA through a qualified charitable distribution. So instead of giving, instead of taking the required minimum distribution, they can give that directly to charity. There's no minimum or maximum amount that anyone can give. And the benefit for doing this is that the gift is fully deductible at 100% of the fair market value, subject to certain limitations based on adjusted gross income. For cash gifts, it's 60% of AGI. For gifts of appreciated property, as it's a publicly traded stock, it's 30% of adjusted gross income.
So a lot of times donors will say, well, I'm worried about how much money I'll have to live on. So in that case, if your goal is to defer giving until after your lifetime, then you can use either a beneficiary designation or bequest to make those gifts. So a bequest can be made, often people do that through their will. They have cash, they might have real estate and property, and that all flows through the will to make the gift. And then the beneficiary designation on retirement plans and life insurance is also an easy way. Again, the gift comes to the charity after your passing. There is no minimum amount that has to be given, and there's many benefits to you to make a gift in this manner. First of all, you have the money now to live on. There's zero cost to you to make a beneficiary designation or life insurance on a life insurance policy. And then there's also, when a gift comes from your estate, there are benefits of estate tax, charitable deductions, and might also reduce death taxes. So the definition of a bequest. Bequests are gifts that are made as part of a will or trust. They can be made to a person, such as your niece, your nephew, your children, or they can be made to a charitable institution like Penn State Abington. Anyone can make a bequest through their estate in any amount. It can be as simple as $1,000 to my grandson, as you see here. Sometimes people say, I want to leave my favorite jewelry to my niece. And you will need an attorney, of course, to write a will and to update your estate plan. You can add to your will through a codicil, which means that you don't have to redo your entire will, but an attorney should help you with that. So a bequest again is a gift that's given through an estate or will or trust. So that's compared to what is a beneficiary designation. So if you want to name Penn State Abington as a charitable beneficiary of your retirement plan, it's very easy to do. And it's a way to make a significantly large gift after your passing. We call these stroke of the pen gifts because there's no need to see an attorney or redo your estate plan. Many of you know, you just go online to your retirement plan and you fill in the beneficiary designation. Of course, you could always do 50% to your children and 50% to a charity, so you can use different percentages to give this gift. And of course, there is zero cost to you for this means of giving, and many donors use this as a way to give.
Another idea that people consider is what we call endowing your annual fund gift. So we do have donors who are contributing at the President's Club level of $2,500 annually to Penn State Abington, and they would like to make that gift in perpetuity. They have a legacy that continues on after they pass away. They can do this by considering a bequest of $50,000 in their will or estate plan. As Judy said, they could do a beneficiary designation for $50,000. And based on our typical endowment spending of around 4%, that gift would generate $2,500 per year forever to Penn State Abington. Listed below are some other annual gift increments just to show you the impact endowing your annual fund gift can make to the benefit of the campus. Another strategy that people do is called early activation. This allows for the impact of a bequest to begin immediately. So we have a lot of donors who already included the Penn State Abington in their will or estate plan, and they'd like to see the impact of that gift while they're alive. So for example, if a donor has included a bequest for $100,000 to create a scholarship, they could make annual gifts of $5,000, which would early activate this gift and leverage the bequest into a larger gift during the current campaign. We use 5% of the level of the bequest typically for early activation, as that's roughly what the endowment would spin off. As a result, donors can see the impact of a student's lives today and meet their students and see what is happening with them on campus. A lot of times a goal for donors are to secure a fixed income or creating an inflation hedge. They can give the apple tree, but keep the fruit with a life income gift. A life income gift pays income to you. It can be funded with cash, non-cash assets, including appreciated securities, some closely held securities, real estate, or personal property. At Penn State, our minimum for a gift annuity, which is a fixed rate product, is $10,000. We also do deferred gift annuities for $5,000 minimum, and that provides a fixed annual income received in the future. Penn State's minimum for a charitable remainder trust, which is variable income, is $100,000. The benefit for the donor is they get an immediate tax deduction equal to the remainder value in the gift. So it won't be dollar for dollar. It might be 50, 60% of the value of the gift based on your age. Again, income can be fixed or variable, fixed with the annuities, variable with the trust. You avoid all capital gains tax on any appreciated property you donate to the trust. And you are provided tax-free income in some cases. And the gift benefits Penn State Abington at the end of the term. To run through a case study of what a charitable remainder trust would look like, providing fixed income for the donor. Donor invested in Amazon stock 10, 12 years ago at $20,000. The stock is now worth $100,000. It is not paying any dividends to the prospect. They transfer Amazon stock to a 6% trust at Penn State. Assuming the donors are currently ages 72 and 70, the result of that gift is an $80,000 avoidance on the capital gains tax, which would save them $12,000 in taxes at the 15% capital gains rate. They would get a tax deduction equal to over $36,000 today, which would also save them taxes of almost $13,000 if they're in the 35% tax bracket. In the first year, they would receive $6,000, and each year the trust is revalued. And as long as the trust is growing, which means we earn more on our investments than we're paying the donors, the income will increase over time. Assuming we can earn 7.4% on our investments, the donors in this case will receive almost $130,000 in payments over their lifetime.
The donor advised funds have been in existence for decades. You might be familiar with names like Fidelity and Schwab, who have been offering these funds, as I said, for many years. However, this has become a cutting-edge technique in the gift-giving world to use a donor-advised fund, because you receive a charitable tax deduction when you make the contribution to the fund, and then when the assets are actually gifted out to the charity, it can be done over many, many, many years. So to open a donor-advised fund, you merely make a deposit with Penn State Giving Fund. The minimum is $5,000, and you can use cash or appreciated securities and other complex assets. And 50% of the fund must come to Penn State, but the other 50% can go to your favorite charities. The year that you make a deposit to the fund, you receive your tax deduction. And then over the next many years, you can grant out the assets in those funds for as little as $50 for each grant. So you can give to the Boy Scouts, the Girl Scouts, other favorite charities that you have, for example, in addition to Penn State. And there is no time limit right now on how long and how many years that you can grant out those funds. DAFs are also becoming a way to involve younger generations in giving. They can be handed down to your children who can continue your gift giving. The assets are in the fund and can be given for many, many years. And this is a good way to include your family and teaching your children philanthropy. So with the Tax Reform Act of 2017, there were several changes. And the technique of bunching is a technique that's being used now to help address some of those changes and help reduce your taxes. So the way that you bunch is you would add up several years of contributions that you were going to make, and you would deposit them into a donor advised fund this year. That means that your tax deduction this year would be significantly higher than it would be as if you would have made those deposits for the next several years. And then that larger deposit will help increase your charitable deduction above your standard deduction. So this is a great strategy to consider. It's also a great strategy if you're getting ready to retire and your income's relatively high, is to make that deposit into your DAF, receive the large tax deduction, but then throughout your retirement, use your DAF to gift while in retirement.
So how do you begin your journey to leave a legacy to Penn State Abington? I think one of the first things you need to do is review your list of assets available for a current or future gift. Any asset that's going to be highly taxed that would pass on to heirs is a perfect example of something to consider for a future gift, such as IRAs or anything that would be taxed as ordinary income. Begin discussing gifting strategies with the development team at Penn State Abington. Work with your advisors to add Penn State Abington to your estate plans. There are many ways to do it, as Judy said earlier, from adding a codicil to your will, or redoing your will or estate plan, or a simple stroke of the pen gifts such as beneficiary designations. If you do update your beneficiary designation on a retirement plan or a life income gift, please share that with the development team at Penn State Abington. We want to make sure whatever future gift is coming to the campus is used for the purposes you want to achieve. If that's a scholarship, supporting faculty, or program support. So you need to work with the Penn State Abington development staff to define how the gift should be used. For future gifts, we use what's called a statement of donor intent, which is a revocable document that is not binding on you in any way. But if and when Penn State Abington receives the money, it's the legal document to make sure your wishes can be followed after your lifetime. For current gifts that are coming in, like scholarships, program support funds, we use what's called a guideline agreement, or an endowment agreement is another terminology for it. That's basically the legal document between you and Penn State Abington and how your gift will be utilized. That document can be amended up into your passing if circumstances change in the future. Additional information can be found on our website, which is listed there, pennstate.planmygift.org. There's a wonderful free personal estate planning kit that can be downloaded, which is a great reference tool to help you through this journey. And also talking to the team at Penn State Abington, Karen Weiss-Jones or Lauren Enlow, or the Office of Gift Planning, Mike Degenhart and Judy Spiegel. And with that, we can open it up for questions.
Okay, so if you have a question, please feel free to enter that information in the chat room. But I have a question that I'd like to start off with. Can you explain a little bit more the difference between a gift annuity and a deferred gift and a charitable remainder trust?
So a charitable remainder trust is exactly what it says. It's a trust, and the minimum to set up a charitable remainder trust is $100,000 with Penn State. It also pays a variable rate, so usually 5 or 6% of the trust, and it's invested. Whereas a charitable gift annuity, the rate that's paid to the donor over time through their lifetime is a fixed rate, and we give them that rate when they set up the charitable gift annuity. The minimum for that is $10,000, unless you do a deferred charitable gift annuity. And what that means is you defer the income until later in your life. So if I don't need the income today, but I still want to set up the charitable gift annuity, take the charitable deduction, but then I don't have to take the income until later in my life. And that does increase the rate when we first set it up.
Right. So I think one way to think about it, with the gift annuity, all the risk is on Penn State. We are guaranteeing a rate at the time the gift annuity is established based on current market situations. So if we're going to pay a donor 5-6% fixed for their lives, all the risk is on Penn State with the investments as we work on that. With a trust, the risk is shared because each year we revalue the trust, and based on the underlying market performance, your income can go up or down. As Judy said, it's variable. So it's more of a shared risk. So we're working together to try to have the right investments and watching the market and doing that. Because a trust is a separate legal entity, unlike the gift annuity, that's why the minimum is higher, because there's additional paperwork that needs to be done, a trust document to establish the trust. And the tax reporting is also different between the two. With a gift annuity, you get a 1099 like you would with a mutual fund with your brokerage firm. With a trust, you get a K1, which is more like a partnership if you've invested in those.
Okay. So if I have children and I know that I want to take care of my children in the future, but I also want to make a gift to Penn State, what is my best option?
We have a couple options that can benefit children. We can do a charitable remainder trust through someone's will, so a testamentary trust, where upon a donor's passing, they would set up a trust for a term of years, not to exceed 20, where income could be provided to a child or a grandchild. Or we also have what's called a charitable lead trust, which we did not talk about today. Those are more complex. At Penn State, our minimum is $500,000. But a charitable lead trust was designed as a wealth transfer strategy. That's where donors put assets into a trust. The income comes to Penn State for a term of years. And upon the trust termination, the assets go to children to receive. So a lot of donors are utilizing charitable lead trusts if they want to pass assets to children, gift and estate tax-free before they're passing. So we've had donors who might have had a large income event, sold a company, needed a large tax deduction in the year of the gift, but really would like the assets to go to children versus coming to charity or somewhere else. So a charitable lead trust is a perfect example of how to do that.
What we often do say, by the way, Lauren, is that if the donor has an IRA and then has other assets, the IRA is the best gift to give to the charity and the other assets to the children because of tax implications of giving the IRA to the children. So that's a good strategy.
So the taxes are higher if they give the IRA to the children,
Correct.
than if they give it to
Then
Penn
there's no
State.
tax if it's given to, and the impact obviously is greater too.
Right, because with an IRA, anything distributed from an IRA to the donor or the donor's children is taxed as ordinary income at the marginal tax rates they pay. With other assets like appreciated stock, real estate, that gets a stepped up basis upon death. So the donor's children basically are their cost basis is the fair market value. So when they sell that, there's no tax due.
So if I'm a younger donor, and I'm younger as in almost 40, and I'm starting to think about planning for my future, what's an easy way for me to make my first planned gift? Is it through a designation in my insurance policy? Like, how do I get started?
So the beneficiary designation is surely the easiest thing. As a younger person, you have to consider if that life insurance would be necessary to take care of your family. If something were to happen to you, that's part of what you have to think through. But if you have excess life insurance, then certainly that's a good way. Quite frankly, the donor advised fund is a wonderful way for a younger person to start their philanthropy, their more serious philanthropy, because they can put the money into the donor advised fund. It's invested, you know, while it's not, when it's not being given away to charity. And then over time, as you develop different interests in different charities, then you can make those, we call them grants when they come out of the DAF to the charities. So it gives you a chance to see impact over time.
And our minimum for Penn State's donor advised fund is $5,000. So with a one-time gift of $5,000, a younger donor can start building up a charitable checking account, and they can make gifts to Penn State Abington or other charities. With the Penn State donor advised fund, 50% of the grants have to come to Penn State at the end of the day. So that's a great way to do it. As Judy said, the beneficiary designations are a great way if people don't need those assets like life insurance or retirement plans, because it allows them to potentially early activate those gifts. At Penn State, the minimum for early activation is $2,500 a year, which is basically a president's level type gift. And with $2,500 a year, they can have a named annually funded scholarship, a program support fund to support the Abington campus.
Okay. Oh, looks like we have a question from our chat room. If I wanted to give a specific Penn State Abington scholarship, give to a specific scholarship like the Abington Alumni Society Scholarship, both now and after my lifetime, what would you recommend setting up?
Well, so giving now, you could obviously give cash or a pledge outright, or after, in not knowing, of course, what the person's financial situation is like, they could designate a life insurance policy or part of their estate. It's very simple to put in your estate I bequest, and then, list Penn State Abington and the scholarship, and then give a percentage of your estate or a fixed dollar amount, like $10,000. So the estate is a great way, again, because you use the money as long as you're alive, and then whatever's left would come as designated.
And because that's an existing scholarship already here at the campus, there's no minimum or maximum amount needed to create it, unlike a new scholarship. That would be a $50,000 minimum endowment. So a lot of people who give money to existing funds that are out there, like the fund that was just mentioned, they can do that through monthly ETFs with Penn State. So if they want to give $500 a month, or $100 a month, whatever they want to do, we can set up ETFs, electronic fund transfers from the checking account. And all they need to know is the 5-letter allocation code, which Lauren, you can provide for them. And the same thing for a beneficiary form, beneficiary designation, just making sure the assets will get to that fund.
We do have donors who, when they're 70 and a half, they have to take a distribution, a required minimum distribution from their IRA. At 70 and a half, they can point that directly to the charity. And so that's a way to give today if you're 70 and a half and have to take that distribution. And that money goes right to the charity, so you don't have to pay income tax on the income. That's a great way. A lot of people give that way. And quite frankly, the laws changed several years ago, so that's a permanent, people can depend on it from the beginning of the year. We have a lot of donors who use this method to give, and then use the beneficiary designation to give the remainder or part of the IRA after their passing to that fund that they've been supporting.
So is there any sort of funding or asset that Penn State cannot accept as a gift?
We can take most anything. The most common types of assets we see are publicly traded stock. We do a large number of gifts of that because of the tax advantage, avoiding capital gains tax and getting a fair market deduction. We do a lot of gifts of real estate. We take closely held stock. We've taken gifts of art for the Palmer Art Museum, gifts for the campus, intellectual property. Anything that is not readily, that can be liquidated readily, requires additional due diligence. So that's something that if somebody wants to give us something besides cash or marketable securities, we need to do our due diligence. So even with real estate, we're going to get a real estate checklist, inspect the property, and we don't accept every gift that's offered to us.
Well, that's good to know.
Yeah.
Okay, so it looks like we don't have any other questions in the chat room. Just monitoring. Well, thank you guys so much for taking the time to come down here and chat with us. And just for all of our viewers online, please know again that we're going to send out the recording to you. And we're also going to share this wonderful slide deck with you as well. So you have all of the information. And we'll just go back one more slide so you can see all of our information again if you want to quickly take down those telephone numbers and email addresses, because I know we're going to be flooded with calls after this today. So thank you guys so much. And I think we're good. Have a great day, everyone.
Thank you.
Thank you.